I'm happy to meet Jonathan Dean from AXA Investment Managers. We meet today in Frankfurt on the AIC, and you just finished your speech, and I'm happy to have you here. Please, we start maybe say a few words about you, who you are and what you do.
Of course, great to be here. My name is Jonathan Dean. I head the Impact Private Equity Fund Management business at AXA Investment Managers. I've been with the firm for 13 years, 10 of which have been spent developing our expertise in impact investing and private equity.
So, Jonathan, you talk about private equity and impact investing today. That is the focus, and you are focused on private equity and healthcare. So let's start with a simple question. How does AXA Investment Managers define impact investing?
Yeah, maybe the way to answer that is firstly starting with what impact investing is not as we see it. So firstly, impact investing is not ESG. ESG is a risk management tool that is used across the whole of the asset management industry today. Impact investing is also not philanthropic. It's not concessionary. It's not charitable. We are seeking to make market rate financial returns from our investments. So therefore, what is impact investing? It's about identifying problems. It's trying to look for problems with society or the environment, quantifying those problems, and then directing capital towards solutions and measuring our success at how material our solutions are at solving the problem. So it's really a part of the spectrum of responsible investment, but really going further to try and make intentional, measurable, and accountable changes.
Where's your focus in the investment strategy regarding to private equity, and we talk about the healthcare market?
So firstly, private equity is a great asset class to generate impact returns within because it's long-term, because you can take active ownership positions in companies through board seats and really have some sort of accountability on what your capital is used for, and therefore, coming back to the definition, linking your returns to the accountability and the intention of your investment in the first place. You do this over a long period of time. So private equity, it's an illiquid asset class, which again is important to be able to lock in your contribution to a company and measuring the success and the use of your capital over that period. Healthcare is a theme within the impact investing space. And for us, healthcare is really important to identify where the opportunity to invest in healthcare is. And that is coming from looking at what is the opportunity in the healthcare market today. And for that, I can see the growth in spending is happening twice as quickly in middle-income countries as it is in high-income countries being traditional European and US markets, and also that there are 5 times as many people in middle-income countries as there are in those high-income markets. So why is that important? Is because we believe the opportunity to invest in private equity in healthcare going forward is beyond traditional high-income markets. And that is exactly where traditional private equity lies. So we are pushing the boundaries of where we invest and trying to scale our companies from high-income markets into those high-volume markets. And that's where we measure our impact, and that's where we can generate both impact returns and financial return.
That would be my next question. Can you achieve a good return with impact strategies, a better return maybe?
Absolutely, and I think this is over the past decade of developing the platform at AXA Investment Managers, we've tested that exact theory. Can you make market rate financial returns from an impact program? And the answer is yes. The answer is that if you think about what makes a company successful, it's very important that a company is sustainable on the financial side. And the theory of making concessional returns through a portfolio doesn't reconcile with a long-term successful financial outcome for a company. So it's vitally important companies are financially sustainable, financially successful. They have to be commercially viable. And in the healthcare space, when we think about that opportunity that I described, going from high income to high volume markets, that is the exact characteristics which drive scale. And it's the scale which is driving market rate return. So from our examples in this space, We have evidence where we have been very successful in delivering both financial performance at above market rate expectations, as well as quantifiable, measurable impact. I'm thinking about a medical device that we invested in recently in the US. So started in a high income market, and we developed a plan for that device to scale globally into high volume markets. And the scale potential of that device is what ultimately delivered a huge value for us when we exited the company last year.
Jonathan Dean, AXA Investment Managers, many thanks for this interview.
Thank you for having me.